Wellesley-Weston Lifetime Learning offers non-credit courses to seniors in the greater Boston area. For more information about WWLL and links to our videos, please go to www.llcourses.org.
Our speaker today is Trenery Dolbeear, who will be speaking to us this morning on the new tax law passed by Congress and signed by the President in late December and how it will affect all of us. We've passed out a chart which you will need to follow as he speaks this morning. Tren received his PhD at Yale in economics, and among his early postgraduate school jobs, spent a year as a Brookings Economic Policy Fellow at the Bureau of the Budget, now the OMB, during the Johnson administration. You know he's a senior citizen from that description. After that, Tren taught at Brandeis for 49 years, where he also served terms as chair of the economics department as Senior Associate Dean of Brandeis International Business School, plus a couple of fill-in years as an interim dean. He taught courses in the public sector, among other assignments, and he showed his students how to deal with the Form 1040. He's always done his own taxes, so he has the practice as well as the theory. We have not had a chance to eat in the dining room recently, since the table is covered with his computer and all the receipts and papers from the last year. I hope you will leave here today with some of your questions answered.
Thank you very much. Can everybody hear me with the mic? I'm going to try to do as much as I can in terms of the new tax law passed in December. I'm sure I'm going to miss a few things, but I'm trying to figure out what it is you're most interested in. And then if I miss a few things, I can direct you to some useful sources of information. If you go to irs.gov on the web, the government the IRS puts out a lot of information about various kinds of tax questions. And if you haven't done that, I recommend it to you. They're probably a little behind with this new tax law since it was just passed in late December. And there weren't any hearings about it, as you probably know. And some of it happened in the dead of night. And so it takes them a while to figure out what's happening and what it is the rules are going to be going forward. In addition, you can buy some tax filings software, such as TurboTax, which is what I always do. And they have a kind of hold you by the hand and take you through step by step. And they also have little snippets of information about how to understand various questions that they ask you. So there are a lot of ways to find out more about it. But I should stress that I'm not a tax professional. I never paid one on TV either. And if you really need to know the answer, you need to find somebody who is expert at the matter and spends all their waking hours doing it. Most of what I want to talk about this morning has to do with individual taxes, and I think that's what a lot of you want to know about. But I should also say something about what's really one of the biggest part of this tax law, which is the cut in the corporate tax rate from 35% on income to 21%. They're going to make it 20%, but they had to go up to 21 so they get a little more revenue. They had standards for how they had to make sure the deficit wasn't going up too much over the next 10 years. As it is, the cumulative effect on the deficit is $1.5 trillion from this. So we're spending a lot of money that we don't have in terms of taking extra government debt. You may recall Paul Ryan, Speaker of the House, saying not so long ago that people say they don't like this tax cut. The polls early on were quite negative, but he said it's going to get better when they see their paychecks coming up in February when the withholding rates go down. Now, I suspect that's probably right about that people will like a little more take-home pay. I'm not sure at what point people recognize that we're spending a lot of money we don't have and get these tax cuts. It's clear to me that if we went too far in the hole, that probably people would recognize that it's not really a tax cut because we didn't have the money to begin with. But at the moment, anyway, the Republicans are telling people that, well, we're going to make it up with growth. Most economists don't believe that, but it's a little hard to see what your share is going to be for future obligations from the tax cut that you're getting. So most times, I think people are not too nervous about this and will gratefully take whatever tax benefits they get. It's also the case that some of the corporate income it's a big tax cut for corporations. And the idea is supposed to create jobs and do more investment. A lot of people are skeptical whether that's going to happen, but the jury is still out about that. It's also true that they've changed the rules about how they're going to tax corporation income, and they're now going to have what they call territorial taxes, which is to say that we're going to tax the income you make inside the United States and not tax your worldwide income. And on the other hand, we have a lot out there, I think it's something like $3.8 trillion sitting abroad, which corporations can bring back if they wish to, for tax only 8% for cash, and I think it's somewhat more. Somewhat more for. No, I have that backwards. It's 8% for assets that are not easily converted into liquidity, and a higher rate will go for that, and then the cheaper rate goes, higher rate goes on the cash. I get that confused here. So you can bring back 15.5% for cash and 8% for liquid assets. Another feature which is unusual is the so-called 20% pass-through. That applies to income earned by partnerships and unincorporated enterprises, sort of mom and pop shops. So they get some benefits for the tax cut, same as corporations. Now, one of the concerns was that immediately you'd have lawyers and doctors and baseball players getting themselves set up as partnerships so they could get this 20% pass-through. So what that 20% pass-through means is you get 20% free of your income not paid taxes on. So it's a big tax cut for those people. Well, they wrote the law so that they're going to cap the amount of money you can take out so that rich baseball players and doctors and lawyers can't do it. And in fact, anybody who makes a lot of money, like $400,000 or so, can't do it. It's going to get phased out. And the IRS is going to have to develop guidelines for what happens. But the mom and pop shops who make less than six-digit amounts of income can exempt 20% of that income as they pass it through to their individual tax return. And so that'll be a benefit for that, and that's what the tax writers wanted to accomplish. All right, so let me switch to some quick discussion about what it is you'd like a tax system to do. In general, we have to ask ourselves, what are you trying to accomplish? Well, we have to get the revenue to pay the bills, so you need to have some tax revenue, and we have to keep an eye on that. And that's one of the things you have to ask of the tax law currently in place. You also, if you listen to scholars who are thinking about what to do, there's the concept of horizontal and vertical equity. People who are essentially similarly situated in the economic scheme should pay about the same amount. So you want to make sure you have read in the tax law in which if you compare Susie and Johnny and they both look the same, they pay about the same amount of taxes. That's called horizontal equity, and it's a good thing to keep in mind when you're putting together a tax system. Vertical equity has to do with the idea that people who are rich probably should pay a little more in percentage terms than people not so rich, because that's one of the ways we organize the country and the society. And you want to ask that. In this case, you all know that one of the criticisms has been that a lot of these benefits go to the rich people, not even counting the fact that corporations cut are going to go to rich people because they own a lot of the shares. And on the other hand, they also pay a lot of the taxes, as you'll see from my chart. But that's one of the questions that a lot of Democrats have been raising about this whole idea. Another idea that I think has been out there is that an old tax is a good tax. And what that means is that if you have something on the tax books, we've gotten used to that. We figured out how to live with it, how to get around it if we have to, or how to deal with it. And changing the tax code frequently, and particularly if it's big changes, causes some difficulty because individuals and corporations will have to figure out how we're going to deal with this new law, and it tends to be disruptive. So changing taxes without good reason is usually not so great. Another idea is you want to get incentives right, so that if you want people to work hard, you want to make sure that you don't have marginal tax rates, that rates on the last dollar income so high as to get people to say, well, I don't feel like working because it isn't worth it. I don't get to keep enough for myself. Most everybody, perhaps everybody in this call would be old enough to remember when the tax rate on the margin was as high as 90% in the United States. And that's been cut back. And so now the new tax law is the highest rate you pay is 37%. That's not quite right. You have to also pay 3.8% for the Obamacare tax if you're one of the rich people trying to raise money to pay for the health care plan. All right, and I think that's all I'll say about that. Let me talk about this chart that I gave you. So pick up that piece of paper. And on one side I have a bunch of incomes, and I'll talk about that in a minute. And the middle line there is called taxable income in bold. And to the right and the left of this, I have two groups. One is the married joint filers and their surviving spouses. If your spouse dies, you can use this rate for a couple of years before you become a single filer. And then on the right side, it says single filers. And that all is going to be based on the same taxable income. And so before I get to that chart, we got to understand what's meant by taxable income. And so I got out my 1040. It looks like there's a 2-page thing and has all these items on you got to fill in. And I made a list on the other side here so you can see how taxable income gets to be calculated. And then on the other side, we're going to talk about how it's taxed before and now and see who wins and who loses and by how much. But the very important part, of course, is how do you calculate taxable income? And there's where some of the big changes have come. So looking on my sheet there, what you do is you get to taxable income on line 43 on the Form 1040. But you got to put together all the income items and deductions and so on before you get there. So if you look at my paragraph that starts wages, W-2 form, that's if you're still working, you're going to get from your employer a W-2 form, which gives income. That goes on a line. And then you may have some taxable interest because you have some investments that pay interest. You may have some ordinary dividends from stock you own. All these things go in on a particular line. And incidentally, if you have some like TurboTax, they'll ask you the question, you fill in the blank. And even these days, you can even download it from the investment firm, from your broker. Then alimony has changed. Alimony is something that used to be that the person paying the alimony could deduct it from income, and the person receiving the alimony would call it income for reporting to the IRS. And now going forward, that's going to get reversed in the sense that the person paying the alimony doesn't get to deduct it, but the person receiving the alimony doesn't have to declare it as income. And presumably, I assume that's just going to change the way the divorce settlements are handled. If it turns out that the person paying the alimony has got a higher income, which is most likely the case, that'll be good for the IRS's revenue line because the person paying the alimony is going to pay at a higher rate. And maybe that's why they did it that way, I don't know. Then business income, that's a Schedule C. If you're running yourself a little business, you have to file that on C. I know most of you are retired, and so you want to understand what it is going to be in common for your retirement income. A lot of you will have IRA distributions, or you get pensions and annuities from a 401k or a 403b. There's a line for that, and all that income gets taxed as ordinary income, even though a lot of it may have been gained by capital gains during the time you had it. When it comes out as ordinary income, and it enters on that line and it counts toward your bottom line and gets taxed on that. Then you may have a rental real estate, and if you do, you have to figure out how much your expenses were, take them out, and then write down the income for that. Incidentally, even though the taxes that you can deduct on are limited to $10,000, if you have rental real estate, then that's an expense of doing business. You can take out whatever it is you have to pay on taxes in your Schedule E for rental real estate. And similarly, royalties and partnerships and trusts and so on in that line. Most of you probably don't have farm income. If you did, you have to enter that. If you got unemployment compensations, most of you don't have, you enter that. And then Social Security benefits. Most of us will have Social Security benefits. If you're relatively high income, you got to pay taxes on 85% of them. That was a surprise a few years ago, but that's how it is now. And so the Social Security benefits, even though you paid in thinking you're going to get it all back, you don't get it all back. You're going to get taxed on 85% of it. And then there's other income. If you're a big gambler, you got to write that in terms of any profits you get. But you can take off your losses and just write down your net profits on that line. Capital gains and so-called qualified dividends. Qualified dividends are dividends which come from stocks you've held for more than a year. They get taxed, but that's in a different part of the form, and so I'm going to worry about that a little bit later on. And that wasn't changed anyway. Okay, so all of that stuff gets added up to so-called total income. I'm up to line 22, which is halfway toward line 43. All right, and then when you get all your total income put together, and as I said, some of you will have items on, some people have it on some lines, not on other lines, and just add up all of them. Then there are items to be deducted. Most of these are not large and don't affect a lot of people. One of the ones that could be pretty big is the taking away the moving expenses. If you go from one job to another and you have to move more than 50 miles, you used to be able to deduct the moving expenses, and they're knocking that out. So now that doesn't count for anything. And I already told you about how the alimony is going to change. So those are going to be taken out to get to the next item. And then there are more things to come out, which is the Schedule A question about deductions. Now, this is where people in Massachusetts and New York and New Jersey, all the big, rich blue states get hit, because now there's a limit of $10,000 on your property taxes plus your state income taxes, any local income taxes you have. And that usually a big item for a lot of people, and it's probably a big item for many of you. And that's now going to be capped at $10,000. That's all you can write down on Schedule A as the deduction. Your mortgages, you used to be able to deduct interest on up to a $1 million mortgage. They're going to grandfather that, but anybody who has new mortgages can only deduct on a $750,000 mortgage. They were trying to get it down to $500, I believe, but there was a lot of resistance to that by the, yes? Well, I don't know. I think it's obviously the case that people who are planning on being able to afford a big mortgage will now realize, if they're smart enough, that they're going to get as much off on their taxes. And so that could affect your willingness to buy a more expensive house that has a big mortgage on it, because you can't take it off. Now, how people will be affected by that, of course, is a behavioral question. I don't know the answer, but it can't help real estate prices, I would think, because it makes buying a house with a big mortgage it's implicitly more expensive. And then the charitable deductions still remains. You can still take off on your Schedule A for charitable deductions, and even do more, I think, than you used to be able to do. But the big change, which affects all of this, is that they've changed the standard deductions. You know, the Republicans were talking a lot about trying to make things less complicated. They're talking about being able to file in the back of an envelope or on a postcard. Anybody that thinks about this for a minute will realize that's not going to happen for most of us. But the idea that you can now, used to be able to deduct as a standard deduction, in other words, no questions asked, this is what comes off. It used to be $12,700 for marrieds filing joint returns and $6,350 for singles. And now that's going up to $24,000 for married, in other words, almost doubled, and $12,000 for single, almost doubled. And the idea they have is that many people are now going to file for the standard deduction. Of course, I should mention the medical in there too. Medical is another thing which a lot of you may have deducting if you spend a lot of extra money not covered by insurance for your medical care. You can deduct that up to, you have been able in the past, that if it's for parts that are beyond 10% of your income, it's going to go down short term to 7.5 and then back up to 10 again. So that could be in that too, an important item for a lot of people. But you can't deduct insurance premiums, so a lot of people don't have that. You add all that stuff up, it's a good chance that it won't go beyond $24,000, including charitable deductions, unless you do a lot of charitable deductions. If you do, then you can take all those items above $24,000 if you're married, filing joint. But the expectation that people writing this bill have is a lot of people are going to see that they can't get above $12,000 or $24,000 depending on their filing status, and therefore they won't have to worry about Schedule A, and it'll be a lot simpler. Another thing that's going to be important is that the personal exemption, which would have been $4,150 per each person to be taken off your adjusted income, that's going to be dropped. So if you have a big family, suppose you have 7 dependents, that's 7 times 4,150, that's gone. So the $24,000 would be small comfort for somebody that had all those exemptions to take out, because there are no more exemptions. And that can be modified a little bit, because if you have children who are, I think, under 18, you can get a income tax credit of $2,000 up from $1,000, I think it is, and you can even get tax back. If you're really low income, you can get tax back up to $1,400 per child. So that helps the fact that you've lost the exemption for that child. I'll talk a little bit later on about alternative minimum tax, which is a mystery to many of us, to most of us, but I think I can say something useful about that. So what I want to get from all this is that getting your taxable income back on the other side, the so-called taxable income line, is not the same for everybody, because you have to go through all that stuff to figure out how much income you have after your deductions and so on. So you got to go through that exercise, and people will be situated differently depending upon what their circumstances are. But assume we've done all that, and we get to the taxable income for any individual, now what happens? Well, for now, turn the page to the other side, and I'll walk you through this table I put together. Down the middle is a bunch of hypothetical taxable incomes from 0 to 5 million. And most of you will fall in that category, the 0 to 5 million. If you don't, then you can figure it out for yourself. Then on the left side, as I said, is all married joint filers and surviving spouses, and the right side is single filers on that page. And so what I've done is to build the consequences of having this taxable income going down the column. Each row represents a different taxable income, and I shaded it so you can keep the rows straight. So, for example, if you look at, let's just pick one at random. let's say your taxable income was $75,900. You see that on the pages down about 7 or 8 lines. Taxable income $75,900. Well, if you look over scan over to the left, you see that the new tax on $75,900 is $8,727. You see that? $8,727 is the tax you have to pay if your taxable income is $75,900. Under the old system, it would have been $10,453. So that's a cut. And way over on the extreme left, you see that's a tax cut of 16.5% for that person, that joint family. Then if you want to know what the marginal rates are, and by marginal rates, I mean the rate you pay on the last dollar earned. So the way this works, most of you probably know about brackets. And so the idea was that we're going to have different marginal rates starting at 0 for the first amount and then going up to a top rate. In the old days, last year, it was 39.6, and this year is 37% going forward. Okay? And so what I've done is to give you what the marginal rate is, and the way that, and you get back, let me explain that whole column. So you see 2 columns. One says new marginal rate, and then it says old marginal rate. And what I've done down that column is that if you see a number in bold, that's a bracket rate cut. So the first person who earns nothing pays nothing, and then for the first dollar you pay at a rate of 10%. And then eventually you're going to go up to 12% or 15%, whether you're old or new. And so I have a larger font, and it's in bold, at an income level where the rate steps up on the margin. You understand? So in other words, if you look down on the new marginal rate, and it says in bold 12%. It's the fifth line down that column called new marginal rate for joint filers. The second column, and you see that 12%. Well, looking over I see that if you had a taxable income of $19,050, okay, then when you go to $12,000, you go up to another amount, another dollar, you start paying 12%, and you had been 10%, and that's the way to read all these changes if you want to know the marginal rate. So to recapitulate what I've done here is I got a taxable income that I pick out from one of these lines on the column called taxable income, and then I ask myself, what's the new tax, what's the old tax, and then what percentage change that is, and then what would be the marginal rate at that income level. And then see they all go up from 10 to 37 and from 10 to 39.6. Okay? And then the same thing goes on the other side for single filers. And they have new tax, old tax, and new marginal rate, old marginal rate, and a percent change. All right? And you can, let me just say that on these lines, what I did was I made a line for every new and old marginal rate for single filers and married joint filers. So if you look across, you'll see on all the lines except for the bottom ones that there's a bold number where it's a tax bracket change for either the new or old rate for the single or the joint. And that's an arbitrary thing, but I thought it would be useful to see where you are when you make those changes. If you want to do a number that is different from that, you want to figure out what the taxable income is something else, then you can figure that out using the lower one, where was the new tax at the lower income level, and then ask yourself how much extra do you earn at that marginal rate and add that in. And that's how you do. People talk a lot about how it's all very complicated. In fact, nobody has to do this because TurboTax does it for you. Or if you're doing something with filing your own from the IRS forms, they tell you how to calculate it, and it's not very complicated. So I never understood why it was that it was such a great idea to cut the number of brackets down from say 7 to 4, which is what the House wanted to do back in the fall. To me, it was never very complicated, and they just made it sound complicated because everybody tells you how to do it, and you don't have to do much. And the benefit of having lots of marginal rates is that you can increase it slowly as opposed to jumping people in abrupt ways that you may not be intending to do. At the bottom, I added some things to 800,000, 1 million, and 5 million because people talk about what's going to happen to millionaires, and so I thought it'd be good to put that in. And if you look at the percentage changes, you can see that by and large the richest people don't get very large cuts in percentage terms. They get big cuts in dollar terms. And so you've got to remember that the rich people are paying a lot of taxes, and so they get a lot of big benefits. They get a lot of good dollar benefits, but they don't add much to their percentage cuts. That doesn't mean they don't know how to spend it on the way to the bank and so on, but that's the way that one works. And so you can see that Congressman Ryan was right, that there are big cuts for a lot of people here, and you can expect that people will start to recognize this unless they didn't get taxable income because of what was on the other side of the sheet, because they lost exemptions and they lost their Massachusetts state deductions of over 10,000, that kind of stuff. So you could look like you're doing well on this sheet and actually be doing much worse because of adverse consequences from the prior sheet where they took away people's exemptions. Yes? Some of the rates went way up? Okay, one for just... Now, where does it say that? Oh. Yeah, okay. Yeah, okay. Yeah. So I think, unless I made a mistake, which I don't think I did, they did some of that. They had some changes. They didn't all cut the margin rate, but the tax take for that was actually down. They actually got a tax decrease. So the way to think about that is they had some tax cuts earlier, and now in the margin it's not going to be so good, but don't worry about it. You got a lot of money in the bank already when you get there. So if you look what happens to that group, they got a tax of $32,000, which used to be $37,000. So they got a $5,000 tax cut. And I think they fiddled with these rates because they were worried about what the total consequence would be. They're only supposed to cut 1.5 trillion over 10 years. And so they had to figure with the rates to sort of make them outright. And so they probably did a few things that no one knows why they did except for that reason to make it work outright. But it's okay. Even though the marginal rate went up a little bit, you've done well before you got there. And that's why they feel comfortable with that. In fact, that's one of the biggest tax cuts that's around there. All right. Let me. What's the time here? Let me see if any question about that before I put the stage down. Yeah. You have what? Capital loss. I don't think they've changed that. I think all the capital stuff has not changed. Let me just say about that. I said I'd get back to that. I might as well do it now. Long-term capital gains and qualified dividends are taxed the same as they were in the past. And the way that worked was that if you're married, filing joint, and your taxable income was up to $77,200, you don't pay anything on your capital gains. If you're married, if you're single, you don't pay anything on $38.6 thousand. And then there's a 15% rate in the middle, and anything over that you pay 15% until you get up to over, for married files, you have 479,000, and there you pay 20% on your capital gains. And for singles, it's over 425, 800 on capital gains. But in general, the capital gains stuff hasn't hasn't changed. Now let me say something about some various features which are of interest. One is the marriage penalty. I don't know how many of you know about the discussion of the marriage penalty, but the idea was that take two people who have the same income, each have the same income, and they're either living together or would like to get married and live together, and then under the old tax law, as soon as they did that, they'd be filing jointly, and their taxes would go up. And so it was kind of a disincentive to get married. Presumably the basis for that was that two can live not necessarily more cheaply than one, but they didn't cost twice as much. So it was okay, people thought, to have the married couple for the same added income, cumulative income, to pay more taxes than two people who live separately because they have two separate households. Now, more recently, we have a lot of people who are living together without benefit of being married, and so they have all that. And if they get married, they also get a big tax increase if they were earning the same income to begin with. The two of the same, Judy and John both earn $70,000 each. They have to pay extra taxes. Well, they fixed that, and they got rid of what they call the marriage tax. The Republicans never liked that because they thought it discouraged you from getting married. And now, except for the high end, if you go through all this, you'll find that if you have the same incomes and you get married, you pay about the same as you would have if you stayed single. And so they got rid of what they call the marriage penalty. Another feature I discovered just yesterday, which I hadn't realized, is that one of the items that you can deduct is a big loss, something like a fire or a flood or something, a big casualty loss. If it's above 10% of your income, you can write it off as a deduction. And now they've changed that. So it's still the case that it's 10% of your adjusted gross income. So if it's bigger than that, you can take off the excess. So if you had a big $100,000 car that you smashed and didn't have insurance on it, then that presumably is going to be, for most of us, more than 10% of your income. You can take off above 10% of your income as a deduction. But now what happens is that it's only deductible. And get this. It's only deductible if the president says the event that caused it was a natural disaster. So in other words, if you got flooded and lost your house without insurance in an area that the president said that's a natural disaster, then you can take it off if you had no insurance above 10% of your income. But if you got flooded and the president didn't say it was a natural disaster, then forget it. You can't take it off. Now, to me, that makes no sense. Except for the fact that it makes it more easily administered. Used to be, you can see some of this administrative stuff that's into the tax code. Used to be you could take off a lot of stuff that you lost. Somebody stole your bicycle. You could write it down on a bicycle and write off $100. And of course, it's very hard to administer that. I'm sure there were a lot of stolen bicycles which weren't really stolen or were recently recovered. And so they knocked all that out and they got to the 10% stuff so that now you can only take off as a deduction items which are really, really big and cause a big loss to you. Why you go from there to saying you can't take off a loss of your house because it didn't happen during a natural disaster escapes me. And I don't understand why they would do that, but they did. Another thing that's very important in this tax law, and maybe affects some of you, is they changed the estate tax exemption. They're trying to get rid of this estate tax. The Republicans call it a death tax. And what it is it's a 40% tax over a certain exemption on anything you leave to your heirs. It used to be for marrieds $11.2 million, which takes care of a lot of people. But now they've doubled that to $22.4 million, which takes care of pretty much the rest of everyone. So if you married couples and you die leaving up to $22.4 million to your heirs, they don't have to pay taxes on the estate. And they tried to get rid of the whole thing, but they didn't succeed in that way. But since they got rid of it, for most people, you have to be pretty rich to avoid that. Let's see. Let me talk about. I want to talk about the alternative minimum tax. This is something that very few people follow, and it's very hard to understand, and I don't understand either, but I'll do my best. The alternative minimum tax, as I remember, goes way back to the 1960s, when people discovered there were some coupon clipping rich widows who didn't pay much tax, they have big incomes and so on. So they got the idea, well, everybody should have to pay a fair share, and so we'll stick in something called the alternative minimum tax, which says you don't pay enough on the regular tax, we'll get you the alternative minimum tax. Now, as I remember correctly, Senator Grassley, who's the Finance Committee guy, said this is crazy, that essentially what we say is we have a tax law that tells what everybody should pay, but we didn't get it right, and so we're going to stick on another tax law called the alternative minimum tax. And that's dumb. What we ought to be doing is to fix the tax law so we take care of this. We don't need any secondary come from behind tax law. But he didn't manage to do that. They have gotten rid of the alternative minimum tax for corporations, but for married couples and singles, it's still around. But it's around in a different way. And the way it works is that for the alternative minimum tax, and this affects people in Massachusetts and maybe affects a lot of you, you deduct a lot of things off your Schedule A, in the past anyway, for your real estate taxes and your income taxes and your mortgages and so on, all that stuff. And as a consequence, your taxable income goes down quite a bit, and you don't pay as much taxes as you would have without it in significant ways. Well, the alternative minimum tax, the way it works is that you can deduct a certain amount from your income. But before you do that, they're going to add in a lot of tax preference items. So all that tax stuff you deducted, that gets added in as part of your taxable income for alternative minimum tax purposes. And so you get whatever your tax was on the regular calculation, plus back in all your taxes you pay to Massachusetts and your city for your expensive house and so on in terms of taxes. And then you have to ask whether you paid 28% of that if you're on the high end, or 26%, not so far down. Its margin rate goes up at some point from 26 to 28. And a lot of people don't make it. And so you see on your tax bill, alternative minimum tax, certain amount of dollars. And that means they're going to take away some of your deductions. Now, it took me a while to figure this out, because I've paid the alternative minimum tax. And what I did was to figure out, well, let me see what happens. I have a lot of taxes. I have a vacation home, and so I'm going to pay a lot of taxes. And so I decided to figure out what happens. So I took off my deduction instead of having, say, $30,000 for this stuff. I said, let's try with $25,000. So don't deduct as much. See what happens. The alternative minimum tax went down by the same amount that the other tax went up. So since it canceled it out. And the implication of that is you're getting nothing out of these deductions, because whatever the one hand giveth, the other hand taketh away. So the alternative minimum tax essentially picks up the fact you're taking too much by the alternative minimum tax standards of your deductions. And so that's a fact of life that I've gotten used to, and maybe you have too, and maybe you didn't realize it because they don't explain it very well. It's very complicated because there's a lot of features in it too. Now, what is going to happen under the new law? Well, the new law has features which mean this alternative minimum tax is going to be much smaller for most of us. Here's what's going to happen. Okay. First is that from your taxable income, they're going to exempt something from this alternative minimum tax income. They exempt, and it used to be $84,005 for joint filers. They're going to increase that to $109,400 for joint filers. So that'll help. That means that your alternative minimum tax will be based on a smaller number by somewhat $25,000, and the same similar for single filers. So that means you have less of it you have to pay on. That'll cut down on alternative minimum tax. And then another feature, which is really important, is that they have what they call a phase-out. Now, the phase-out is that you have some tax benefit, and then above a certain level, you start to lose the benefit as you go up, and eventually it's all gone. and a lot of phase-outs to exemptions, for example, now are phased out. People who have a large income, they don't get any exemptions because it's been completely phased out over time. People who have not quite so high income, they'll find that their exemptions are going down a little bit. The value of because some of it's going to be phased out. They take it away from you at, say, $3. They take out $1 exemption for $3 of income kind of thing, and eventually you'll get it gone. Well, the phase out for AMT now happens at a much higher level. So you get it out at $500,000 for single filers. Used to be $120,700, and it's up to $1 million for joint filers. So you don't lose your AMT even if your income, your exemption doesn't go away. Now, okay, so that also makes it. Now, the big thing, though, and I think likely the most important, is because the capping of state and local taxes for people in these big blue states I was talking about earlier, that tends to remove much of the stuff that used to get reduced that forces you to pay AMT. So I told you a few minutes ago how I took $5,000 out of my tax that I itemized, and see what happened. Didn't make any difference to the bottom line. Well, now under the new tax law, I'm going to go down to $10,000, and I expect to pay not very much AMT because I'm not going to look like I got much extra added in because they don't let me take more than $10,000 on the taxes. So those people that are kind of complaining about how hard it is in Massachusetts and New York and so on, a lot of them maybe they didn't realize they were bad off to begin with because already they were taking it away by the AMT, and the new laws just mean they're going to give away less on AMT and have to pay more on the regular tax. So what you do is you have to pay whichever is larger, the AMT or the regular tax, and it may be pretty much the same anyway. All right? Now, like I say, a few minutes left. I should let you ask questions. I've probably forgotten a few things, but you can look it up.
Does anyone have any questions? Nobody.
Home equity loans. That originally, when the tax plan came out, it said that home equity loans was going to be, deductions would be discontinued. That I saw there was a clarification from the IRS that said if you take a home equity loan, provided you use it for construction or home repairs, then the home equity loan interest would remain deductible. I presume subject to the same $750,000 max. The impact it had on me was that I took home equity loans to finance graduate education for 2 children that I didn't anticipate. And the fix was to just go back and refinance my house, and I'm still got plenty of room to $750. But has there been any discussion on that? Because there would have been some predictable impacts to the construction industry.
If you're going to take a home equity loan to sort of basically expand your home per se, so as if you're buying a new home or something or fixing it up, that it's something that the IRS would say that makes sense. But if you're taking the home equity loan so you can send kids to college, they're going to spot that, and they may have to ask what you have in mind. But certainly in terms of the spirit of what they say, what you said is to me makes sense that that's what they'd be doing. But I haven't read anything about that, and so I don't know.
Okay, anything else?
Yeah, thank you very much. Remember what I said, you can go home and look it up on irs.gov and also the internet, look for topics that I didn't fully explain for you. And good luck when it comes to 2018 filing, and I hope you enjoy your tax cut.